So from a company perspective, we did analysis for Fast Company magazine, which you can find at fastcompany.com/investing. And we looked at what is the profit at risk here. And we'll look at this in Chris's case study as we dig into that at the end of the presentations. But for large oil companies, this could be anywhere between 8 and 19% of profit, and that's only at a $20 price per ton. It's likely in the future that carbon could cost upwards of 30, 40, and possibly triple digits. So it's something to pay attention to. This is something that would affect profitability. However, there's a difference between whether there's a carbon tax and a cap-and-trade system. So as you see here, Eni, the Italian oil company, and ExxonMobil are more inefficient than companies like Marathon, Chevron, or even Repsol in Spain. And depending on how efficient you are today may affect how profitable the carbon markets are. Another place to look at the financial value is in the capital spending. So again, in the big oil industry, if you add up the capital spending of all the top 10 oil companies globally, it's about $139 billion. Interestingly enough, that adds up to the total wealth of the top 3 richest people in the world, Carlos Slim, Bill Gates, and Warren Buffett. If you were to analyze what percentage of that $139 billion in capital spending is focused on renewable energy, you will find that it is in the low single digits. And so more than 95% of the capital spending of the current fossil-based energy industry is going into more fossil on a future basis. This makes renewable companies, I think, a merger and acquisition opportunity for your portfolio. So you can find out more at fastcompany.com/investing/2008, where we looked at those oil companies. So what does this mean from an investment perspective? Companies that manage in this way, that translate environmental value into financial values, who know what their carbon accounting looks like and manage it lower, tend to outperform. On the left-hand side here, you see how the HIP 100 index has outperformed the S&P 100 index from the end of 2002 to the end of 2008. And this year in 2009, it's mimicking the downside. So for no extra downside, there is positive upside. Mutual funds like Calvert have underperformed during that time period. And on the right-hand side, more environmental-focused investment funds like Winslow Green Growth Fund and Portfolio 21 and KLD, again, have underperformed slightly or more to the HIP 100 fund, which tends to be more stable. We even looked at this from a super green perspective by triple weighting the earth factors and underweighting the non-enviro factors, and we have similar performance. Companies that are strong from that environmental perspective are United Technologies, which again becomes #1, and UPS, IBM is a strong performer relative to peers in the sector. The companies that fall lower, Procter & Gamble, very positive, but just less so on the environmental side. Pepsi is a little bit lower. Johnson & Johnson disappears. Halliburton ends up looking like a decent environmental performer, and a Target joins the list. So Goldman Sachs has shown that environmental performance drives financial value, both, again, from 2005 to 2007 and from 2007 to 2008, where emerging companies have a little bit more upside than mature companies. And from an M&A perspective, last year Clorox bought Burt's Bees for almost $1 billion. And you'll see companies on the left that have always had an environmental value proposition from their product as well as how they run their company. And they've ended up being acquired for significant premiums. So this makes sense both from an entrepreneurial perspective as well as from a large company perspective. So finally, what management practices do you have in place to be able to do this? So there are 5 categories. This is inspired by the McKinsey 7S model. From a vision perspective, companies like Walmart have set aggressive goals like zero waste and 100% renewables. The timeline is starting to emerge on when that will happen, but Walmart is driving that through its supply chain and through the scorecard that it applies to its supply chain. And if you add up all the revenues of all the companies who supply Walmart worldwide, it totals about 1/3 of global GDP. So if you change and transform your supply chain, you can change the world. This could be particularly appropriate to those of you on the call who have significant supply chains. And you're probably familiar with Interface, who has targeted zero emissions by 2020. Companies like in the second category of performance measures, ecometrics alongside financial metrics. Companies like Alcoa track this on their website. Intel has a very detailed environmental and talent scorecard, again, alongside financial metrics, as does United Technologies. On the financial side, for companies like GE, even though their shareholder value is depressed right now, mainly from their banking exposure and financial services unit, more than 10% of GE's revenue comes from products that have an environmental competitive advantage. And real estate investment trusts like Liberty Property Trust save 40% of bills for their clients in doing facilities management for very little, if any, extra capital. And we mentioned tax credits related to Walgreens previously. So companies like Herman Miller and Salesforce.com have large green teams of several hundred employees across the company. That helps increase accountability not only from the top down, but from the bottom up, and really makes it a participative process. And so I think one of the opportunities here in doing more carbon accounting and linking it to financial accounting is how to spread the pilots across your company and to find a product group and where in your product mix it makes sense. And then finally, from a decision-making perspective, which we'll cover in the wrap-up. So as you look at the overall S&P 100 companies, along the bottom side, there's the quality of management practices, and on the up and down axis, the y-axis, it's the overall net positive impact. So the takeaway here is that most companies are still not above the 50% line in generating more positive than negative quantitative outcomes, and more companies still aren't very sophisticated on the management practices side. These are all as of the end of 2007, so we'll have an update on 2008 during the summer. And it varies by sector, so less capital-intensive industries like technology, telecom, and in some cases consumer staples can move faster than more capital-intensive industries like energy, consumer discretionary like the auto companies, and utilities. But also the type of talent that you attract that can matter as well. So in conclusion, since we're talking about accounting, and I started out as an accounting major, you're sometimes called a bean counter. So if you bean count according to HIP principles, don't forget to count your carbon. And so one, make sure and quantify your impact around measurable outcomes. Link it directly to how it drives profit, revenue, costs, taxes, as well as discounted cash flows and net present values. I like to say if you have a specific project to pitch internally to do the discounted cash flow or NPV or IRR first, and show it to your CFO to show them the numbers, and take the project description to them second, so that there's not a bias against environmental initiatives. Secondly, whether it's your R&D process for designing new products, your capital spending process, and the environmental and social criteria you might have around that, especially if you're in project finance. The Equator Principles provide great guidance for 80% of the dollars of project finance. In your annual or quarterly budgeting, as well as regular income statements, and from your supplier perspective. You can integrate these environmental criteria into your decision. And then finally, publicizing this to shareholders as well as Wall Street. So Jones Lang LaSalle, in its quarterly call with Wall Street analysts, will have at least one slide on their sustainability measures to show how environmental value leads to financial value. So you as a company can help to educate the investors who cover you by showing them how this works, and that's a quarterly process. At the shareholder meetings, companies like Cisco are designing not only stakeholder involvement, but also sustainability projects, sharing those, John Chambers, leading the discussion on that at shareholder meetings. So consider designing that into your next shareholder meeting. And then finally, reports like the Carbon Disclosure Project provide information that sometimes aren't even disclosed in annual reports. That may raise the hairs on the back of your neck of your general counsel's office, but it is a way to, again, gather a positive attention for the positive environmental initiatives that you're describing. So that's a very quick overview of HIP. We're going to turn it over to Chris here to talk more in depth about how carbon accounting lines up with financial accounting.